We're good.
Good morning. This meeting of the SIRS Investment Committee is now being recorded for record-keeping purposes. By participating in the session, you are consenting to the recording, retention, and future viewing of this meeting. The meeting is now being live-streamed. Thank you.
Great, thank you. Good morning, everyone. I would like to call to order this April 28, 2021 meeting of the Pennsylvania State Employees Retirement System Investment Committee to order. May I have a roll call, please?
Yes, this is Jim Nolan. I'll take that roll call for you, Mr. Becker. And we'll start with you, Mr. Becker.
Present.
Yes. Senator DeSanto.
This is Chuck Erdman for Senator DeSanto. He had to step away for a moment. He'll announce himself when he's back. I'll be standing in momentarily.
Thanks, Chuck. Chairman Feldman.
Present.
Representative Frankel.
Here.
Treasurer Garrity.
I'm here.
Hello. Senator Hughes. Or we have
Tony Marchowski here on behalf of Senator Hughes.
Yep, Tony. Okay. Thank you. And Mr. Jordan.
Here.
Mr. Thal.
Here.
Secretary Vag.
Here.
Okay. Everyone's present, ready to go. Glenn.
Great, thank you. Thank you, Jim. We have a lot to cover today, as usual, and we're starting a few minutes late, so I just ask everyone's help in getting us back on schedule, and keep in mind that this meeting is all that stands between us and lunch, so there's an incentive to move in a concise fashion, I think. The first order of business is the approval of the minutes of the February 23, 2021 Investment Committee meeting. May I have a motion, please?
So moved.
Thank you. May I have a second?
Second.
Thank you. All in favor, aye?
Aye.
Aye.
Opposed? No? Okay. Hearing none, the motion is passed. We have no old business today, and we'll move on to new business. Again, in typical fashion, we've got a lot to cover today. We'll start with some updates by the investment office, and then we have a private equity opportunity, and then we need to approve some recommendations on the private equity manager structure, and also approve the long credit manager search procedures, and then some administrative matters. So a lot to cover, and I will turn it over to our CIO, Seth Kelly, and his investment team. If you would, Seth, please take it away.
Thanks, Glenn. I appreciate that. I assume everyone can hear me. If not, just let me know. So as you'll notice, there's a little bit of a lag between performance and when we can actually call things final. We really don't get, if you kind of think about the quarter end, it's sort of a month lag, and then it takes some time to generate the official reports. I can report that for the first quarter we were up around 3.5%, which is a pretty good quarter. If you multiply that by 4, you kind of get a good result. But I wouldn't do that. That would be a bad habit to get into, given the volatility we take in a portfolio. The next item would be just an update on the fixed income transition, and I would turn that over to my colleague Bill Trong to update you on. Bill, if you don't mind taking it away, please.
Thank you. Good morning, members of the committee. The fixed income presentation is located in section 5A in board docs. Could you turn to the next slide, please?
Next slide.
Thank you. Last December, the board approved a new fixed income structure. And the objective of this presentation is to provide an update to the committee on the transition to the new fixed income structure. The table on slide 1 provides an overview of the old fixed income structure and the new fixed income structure. Could you turn to slide 2, please? table on this slide shows the portfolios that we opened and funded for the new fixed income structure. The majority of the portfolios were opened and funded by March 1 over a very short time frame, and we're on track to implement. We also transitioned actually 2 existing portfolios to the new fixed income structure that we felt were a good fit into the new sub-strategies within fixed income. Please turn to the next slide. Our game plan that we discussed with Callan and Seth and everyone was to fund the new fixed income structure over an 18-month period to average in our exposures, which lowers the overall risk of a full transition at one point in time. We anticipate, in the bottom ring charts, we anticipate completing 40% of the transition in June of this year and fully complete the transition to the new fixed income structure in July of 2022. And that is the update for our fixed income, our new fixed income structure. If there are any questions, we are happy to answer. All right, thank you.
Thanks, Bill. I just overlay the notion that everything goes well with the transition, so progress is proceeding according to plan, and there have been no hiccups really of any kind to report. So that's good. And then we did have a rebalancing transaction, which I will let the Deputy CIO Jim Nolan talk about. Jim, you're up, buddy.
Okay, thank you, Seth. Appreciate that. If you would, in the same section of board docs that Bill just referenced, 5A, you'll see a presentation in there with a rebalancing summary. Seth, can everybody hear okay? Glenn, can you hear me?
Yes, you're good, Jim.
Yeah.
Okay, good. Thanks. Yeah, I wanted to point out, initially, one of the first things Seth asked me when he joined, and we jointly talked to Glenn about during our weekly IC chair calls, was where's the rebalancing policy? That it's well documented. There's some extra return basis points, not full percentage points, but there are excess returns to be had by implementing a good rebalancing program. So that was one of the first initiatives Seth got approval for, and we have conducted a couple of them, and I'm going to cover the one that we just transacted in March 2nd, to be specific. So the idea of the rebalancing program is to enhance performance, both locking in some excess return that's in place at any moment in time, and also setting the portfolio up for future compounding, perhaps at a more attractive rate. Now, we keep in mind transaction costs and fees through this process. We don't day trade, nothing like that. But when the exposures get away from the target far enough to justify the costs to implement, we go develop a presentation with a series of options for Seth to review, and then finally work in consultation with our consultant. And I'm just going to cover the March 2nd one here with you today. So if you look at the first page of the presentation labeled background, you'll see some of the highlights. I'm not going to read the entire presentation, spare you of that, we're running a little behind. But the drivers of this transaction, you can see in the second bullet point, equity was overweight by 3%, and fixed income was underweight by a similar amount. What we referenced the capital preservation bucket, fixed income, TIPS, cash. So that gave rise to staff coming up with a recommendation to Seth. Secondly, as staff dug into it, it was identified that the small cap, as the markets are reopening from the pandemic, small caps have had unusually strong performance and became overweight by a couple percent as well. So we worked that all into the scenarios that were presented to Seth. International was also participating to a lesser degree, but it did. And that ended up with the final recommendation that worked best in Seth's mind and the consultants was to reduce public equity, increase the fixed income, and further our transition, as Bill just outlined, to the new fixed income structure, and finally to increase cash for the all-important mission of paying benefit payments. The next slide recaps the portfolio on a before and after basis to conveniently show you where the underweights and overweights were and where they ended up after the recommendation was implemented. And as you can see, the goal there, at least with the liquid public markets, are to get those variances as close to zero as possible, again being mindful of fees and transaction costs. So it looks like a pretty good rebalance. They take sometimes a couple of weeks to get fully implemented, especially with the international markets, and you could have some variation, so you seldomly would get right to zero. So I think that was a pretty successful rebalance there. The next page, we flip the same data's here, but this is broken out in a little different perspective from a risk management point of view. The capital preservation bucket at the lower third of the slide is what we think about to be able to cover benefit payments through an extended period of time, like Alan Flanagan was talking about during the Q&A at the finance meeting. And we provide that detail in the monthly report to the board, and we're upwards of 7 or 8 years of benefit payments could be covered by this capital preservation bucket if needed. Now, obviously markets are moving, they're volatile, as Korn Ferry indicated during their presentation, but computerization, call it what you want, corrections occur very quickly and rebound as we experienced last year during March and April, and look where we are today. So with that said, the next page covers the various managers or strategies, we call them, that were involved in this rebalance. Again, these numbers are all the same numbers you've looked at on the previous 2 pages. This just gives you a sense for where money was taken from and where it went. And the following 2 pages after this are the same exact data, just broken out for your convenience, showing what was generating the funds for the final page to buy those fixed income assets and build up the cash portfolio. So with that said, any questions? Trying to be mindful of time here, don't mean to rush.
Does not look as though there are.
Yep. Turn it back to you then, Seth. Thank you.
Thanks, Jim. Appreciate that. So next on the agenda is a private equity opportunity we have, and I'm just going to turn it over to my colleague Dave Felix, and he'll lead us through that.
Thank you, Seth. Today, we're under Section 5B of the Investment Committee agenda, under private equity opportunity. We're recommending Providence Strategic Growth Fund 5. This is an existing relationship for SIRS that goes back to Fund 2. As you recall, they were here in December when we recommended their European fund. The PSG is very transparent, has made great efforts with their diversity and ESG. PSG 5 is targeting $3.25 billion to focus on minority and control investments in software and tech-enabled service companies. The firm is very experienced and has a deep team. As a top quartile, I would argue top decile track record with an extremely low loss ratio. We are recommending a $50 million commitment to this fund. Mike Elio will provide some commentary on StepStone's GP conviction. Mike?
Sure, thanks, Dave. You guys already have 74 pages of our thoughts, so I won't dig into that considering our time constraint right now. Look, Providence Growth is a very high conviction manager for StepStone. We've worked with PA SIRS from Fund 2 to today. building this relationship. This relationship fits squarely into our strategic plan of embracing the strong relationships that we have on the platform and growing with them. And we have done that throughout this relationship with PSG. I will say it is technically in the IT space, but from a portfolio construction standpoint, this will be in the growth area as opposed to buyout in our portfolio construction, and will give us a diversified exposure to this particular sector. And clearly the numbers speak for themselves. They've done quite well. So I will not steal the thunder of the GP who is sitting here listening to me say nice things about them. So I will let them present their materials now. Thanks, Dave.
Thank you. Peter, Mark, and Lisa.
Great. Thanks very much for having us. And we'll try to just hit very high level here, given limited time and the fact that I think we spoke to most, if not all, of this group in December, and this is the exact same strategy, just in the US versus Europe. The PSG franchise today, we're one of the largest software teams in private equity globally, 93 employees focused on this strategy. We've deployed around $4 billion. We've got, I think today in the US, it's about 50 active platforms. The returns have been great, but what we're focused on is just continuing to do exactly what we've done in the past, which is, you'll see if you have our the public presentation on page 2, we're all about the founder bootstrapped small software companies and being that first institutional capital, partnering with these founders who have reached profitability or break even. This is not venture capital. We are a much less risky strategy given the loss ratios we're trying to drive here. And we want to find these companies where we can deploy less than 50 million to start, high growth. We just think it's the best risk return in this market today. And part of what's going on, if you were to turn the page to page 2, you see is we're manufacturing deals up the market where there's a lot of capital. All these firms keep getting bigger and bigger. And so when we've got companies to exit, I mean, today we've got about 20% of our overall portfolio for sale. So it's a great market for us to be selling into. When we can get to critical mass, we've got more exit opportunities than we've ever had in the past. And really, in a lot of ways, COVID has put a spotlight on the eloquence of the software model and how strong it is to be investing in this end of growth. So with that, I'll turn it over to Mark to talk a little bit about our team.
Yeah, as Peter mentioned, we are one of the largest teams in software. I think we're definitely in the top 5, if not top 3. We have been very focused on increasing diversity with both in gender and ethnicity, and we've done a pretty good job. We're now 40% minority employees within the firm, and we're about 23% female. So we're happy with that, but we've been continuing our focus to increase those numbers. And we've, for example, I think 6 years ago we started an internship program to attract diverse candidates. We started with 2. This summer we'll have 26. So that's really ramping up nicely as the team ramps up. We've also started a very important initiative with our portfolio companies, which can be even more impactful. We have currently 12,000 employees in PSG-owned software companies, and we've created a new program called the PSG Technology Fellows, where we sponsor the technical education of candidates who have are people of color, females who have not gone down traditional paths, haven't gone to college, but we identify the aptitude and interest in learning about the software business. We provide their education, and then we have an apprenticeship with portfolio companies. So this program has its first class, be about 30 folks starting this summer, and we think we can actually really ramp this up. And we've got a target of hiring 10,000 people in the next 10 years for portfolio companies. Obviously, we're just starting, but we think we'll get there fairly easily. And it's solving a talent need across our portfolio, and it's also obviously the right thing to do. So one of the most things I'm excited about in terms of talent acquisition and development. And I would just say, comment also just on our ESG overall policies, if you want to flip to the next slide. This is something that is embedded within everything we do, from underwriting deals to managing portfolios. We really want to be best in class in ESG. And I think really with the software industry, the most important things for us to do and impactful is really focused on social. And we've had a major emphasis for the last year and a half on social justice, racial equality. We have done a number of programs both for our team and our portfolio companies, and have some pretty cool initiatives that we're working on. One now being helping to gain visibility towards the GI Bill Repair Act, which Representative Jim Clyburn from South Carolina, Representative Seth Moulton from Massachusetts will reintroduce into Congress in a couple of weeks. Ralph Warnock, from the new senator from Georgia, will be sponsoring on the Senate side, and the goal is to provide the benefits to African American veterans who were denied the benefits of the GI Bill in World War II. And so those benefits obviously would go mostly to descendants because it's been so long. But we really think that's a very important bill, and we're doing everything we can to raise awareness around that. I want to jump then to the next page and really just talk about high level the trends in software. Software had a lot of tailwinds prior to COVID as businesses start to adopt cloud and mobile communication platforms, really become digitized, is how a lot of people speak about it. There's a lot of automation and AI that's happening, and a lot of innovation around that, and that is kind of a next wave of growth for PSG to take advantage of and continue to drive really strong investments results for our investors. So we continue to be really excited about that. Peter, you want to talk a little bit about the valuation environment?
Yeah, sure. So if you were to look at page 7, I mean, this is really the crux of why our strategy has historically worked and why we have a high degree of confidence in how it'll continue to work. If you go one more page, page 7. So if you look at the blue squiggly line, that is public market values for SaaS companies, which is what we invest in. And right now, those are trading at 13 times the next full year revenue. Our average entry for our initial investments across our history has been at 4 times. And then our additional capital that goes in to fund our tuck-in acquisitions has been at 3 times. So what you can see here is even if the public market, which is at lofty values right now in our opinion, were to drop in half, we still, in our underwriting, are well within our ability to generate the returns that we've historically generated and what we underwrite to. So we're not contemplating a market stay at this level, but we just want to demonstrate that we have, a very large cushion based on where the public market, and the last couple of companies we've sold in funds that you all are investors in have exceeded that 13 times revenue multiple, just to give you an idea, and they've both gone to private equity. So I think that's just to kind of wrap it up and give you the highlights. I mean, we are all about being in the lower middle market, starting small, staying out of the highly competitive areas, being the biggest, best resourced player at that small end of the market, instead of moving, as many of our peers have done, into investing in the larger companies where, candidly, there's a lot of well-resourced, great firms, and we'd rather stay where we have competitive moats and competitive advantages. So we have a huge investment in sourcing and 26 people on our operations team. It's staffed like an internal software company. We're highly experienced. This model is now very well proven. And as Mark was talking about, we've had a big investment, both culturally, financially, partner time, in creating more diversity and embracing kind of the ESG commitment that our investors are also very focused on. So with that, if there's any questions, we're happy to take them.
Greg Jordan, looks like you have a question. Please ask away.
Okay, thank you, Seth. Thank you for your presentation. In the materials I read, it talks quite a bit about the add-on acquisitions, and I would just like to hear a little bit about, how you determine, actually what is an add-on acquisition, how do you determine them, what's your typical add-on, and what's the typical cost, it seems to me that, you're buying additional companies that fit in with a specific platform, but I don't.
Exactly, where it's either competitive or complementary products, where maybe it gives us geographic expansion, maybe it gives us a product or end market expansion. Across our history, we've done about 300. Average revenues have been only $5 million, so these are tiny companies, and our average purchase price has been about $15 million. And this is really, it's the right question to ask, because this is the crux of our strategy. Our willingness to resource to go that small is where the real value is, because then we get that arbitrage and we create scale. We've de-risked the investment. And when we have that greater scale, we start to be able to get closer to what those public market multiples look like. But it's very time consuming. You have to have a really large team to do this. This is not easy to do. It can be very messy. You've got to figure out how do you merge cultures, locations, the product suites. We have a large technical team to make sure we execute against all that. So it's the crux of our strategy.
Okay, thank you. I appreciate that.
Sure.
Are there any more questions? If not, I will turn it over to Dave if you want to close, and then we'll turn it over to Chairman Becker for the motion.
Sure.
Thank you.
Thank you, Seth. So yeah, as I said before, PSG is one of our best performing growth equity managers, and we're recommending a $50 million commitment to Fund 5. And that's basically it from me.
Chairman Becker, you can have the floor.
Okay, thank you. So, a motion is in order to recommend that the State Employees Retirement Board commit up to $50 million to PSG 5 LP, plus investment expenses and pro rata share of partnership operating expenses consistent with executed partnership documents as a follow-on investment within the private equity asset class, subject to successful completion of contract negotiations and execution and delivery of closing documents by all parties, including required Commonwealth legal approvals within 12 months. May I have a motion, please?
So moved.
Okay, we have a motion. May I have a second, please?
Second.
Okay, thank you. We have a motion and a second. Is there any further discussion before we go to a roll call vote? Okay. If not, Jim, could you do the roll call, please?
Yes, sir, Mr. Becker. I'll get on that. Start with you.
Yes.
Thank you. Senator DeSanto.
Aye.
Chairman Philman.
Aye.
Representative Frankel.
Aye.
Treasurer Garrity.
I'm going to abstain.
Thank you. Senator Hughes.
Aye.
Mr. Jordan.
Aye.
Mr. Thal,
Aye.
Secretary Vag.
Aye.
Okay, that's it. Unanimous vote there, Glenn, or one abstain. Sorry, all yeses, one abstain.
One abstention. Okay, thank you. Thank you very much. Okay, so the motion passes. Thank you to PSG and Stepstone and the Investment Office for a very good presentation. Appreciate that. Okay, with that, I will turn it back to Seth.
Thanks, Chairman. So now we're on item C. As much fun as private equity opportunities are, this is kind of where I get excited in terms of trying to figure out portfolio engineerings to help solve for the liability that the system has. So I'm going to try to go through this pretty quick, 15 minutes or so, and then I'm going to hand it to Tom Shingler so he can give his sort of independent perspective on what these things do and are for you to consider as well. Excuse me. So if we could bring up the presentation titled SIRS Equity Portfolio Structure Recommendation, and I'll try to holler out page numbers as I proceed. We can go to page 2. So this is sort of how I start. I think you should get used to this with almost every recommendation that I bring forward, because this is our financial situation, and it's truly what informs my decision making as I think through what kind of the way to financially engineer a solution. If you start at the top, you can see what our benefit payments are and our contributions, and this is a 5-year window, and I think we've talked with the actuaries, and this is all the actuaries' data, so we're not making this up. It's the same stuff you guys saw earlier in a previous committee. And it's for about 5 years, and we feel really good, somewhere in the 90 handle % confident that these numbers are good, and so therefore when you can definitely plan with these numbers. So just kind of looking through the 2021 column, you can see that what our benefit payments are and what our contributions are, and that net cash outflow, as I look at it now, it's positive, but in fact it's negative. So we have to come up with a little over $1 billion. The nice thing is, as all portfolios do, we earn interest and dividends, and that is represented in that total yield row. So that's sort of what our assets do for us in a passive context. And then we have this annual liquidation target, if you look at that row. And then I kind of split it out per month, so you can just kind of see that every month we come in and we have to come up with that much money. So my objective is always to reduce that liquidation target to the extent possible, because if we can reduce the liquidation target through either contributions or yield, then our need to hit the market in adverse environments is small or maybe non-existent. And I think that gives us room to maneuver, it gives us room to be tactical and maybe earn extra return. But if we have to hit the market in an adverse environment, first you're selling at low prices, we can see that easy, but oftentimes in those environments, bid-ask spreads are wide, and so you pay more to transact in the market. If we could flip to page 3, I kind of went through this. The point being the last statement on that page, which is how can we use our capital as efficiently as possible to achieve those benefit payment obligations. And that's kind of what the mousetrap in my head does during the day to try to figure that out. We can flip to page 4. The way I think through capital efficiency is sort of like how can we extract a rent from the assets we have? We have these assets. We know we're going to have to liquidate them at some point in time. Like the idea the fund grows to the moon isn't real. We have a liability to pay for. But if we can extract a rent while we have them to help us along the way, I think that is kind of, from my standpoint, the definition of capital efficiency. It just seems like a reasonable idea. If you're going to sell something anyway, why not get paid along the way to do it? And it's sort of, we did that in fixed income too, right? We allow the liability to define the fixed income characteristics, and then we basically said, okay, now how much, let's get as much out of that stuff as we can to meet our liability. And that was exactly the same process we used in fixed income, which was the transition that Bill Trong talked about earlier. We can advance 2 slides past the next, so slide 6. And so we're going to talk about covered calls here a little bit, also known as buy right. It sort of depends on how long you've been in the industry, whether you call it covered calls or buy right. I've been around long enough that covered calls is what it was in the 90s. So really, when you think about what we're trying to do here, it's turn our equity portfolio into cash yielding investments, which, you know, as you can see, if you look at the S&P 500 column and you go down to the yield rows, you can see that the S&P 500 doesn't yield a lot. So we have to find a way to turn those investments into yielding investment, into yield. So if you look up at the return row in the S&P 500, however, you can see that there's a lot of what I'll call capital appreciation gain in it. So what we want to do is trade off some of that capital appreciation gain in exchange for yield. So I'll just flip you over to the covered call column. And you can see that's exactly what this strategy is engineered to do. The real benefit of this is that the way covered calls work is that you basically, if you kind of think about it, you're getting cash flow up front, which is preferential to us because we're paying benefits every month and we have negative cash flow. In order to do that, we kind of sell some of the upside in our equities. Because whoever is going to give us that cash flow today, they want to trade off some potential gain in the future, and that's kind of the game we end up playing with the market. So what you can see is that in the return column, we don't earn as much in return, and you should never expect to earn as much in return in these strategies, total return or capital appreciation type return. But you do earn most of your return, and in all cases, all of your return through yield. So you cash flow. And that's the trade-off. It's very important. Go back, if I went back to slide 2, we could go through why it's important, and that's the negative cash flow. And I also want to point out something. If we go over to the high yield column, we're somewhere between equities, which is the S&P 500, and high yield, which are bonds that provide a coupon payment. So we're trying to take this equity investment we have, and we have a lot of it, and we're trying to turn it into something that sits between equities that yield in a low way, high yield, which is a bond and has really not much upside potential. And so covered calls kind of sit right between those two things. They have a little upside potential and they yield. So that's really the engineering of the covered call, if you could go down one more. And I'll hit this slide briefly. Really, if you think about how we earn return, total return is what we talk about all the time. And you can break it up multiple ways. I can think of 3, but the easiest for me to think about is what we earn in risk premium and what we earn in yield. And those two things add together to create total return. And remember, we have a preference for yield right now. We still need to earn 7, but we have a preference for yield. So when I think about this, what I'm trying to do is engineer that formula to the point where we're earning as much as we can with the yield component. Obviously, we're probably going to trade off some of the risk premium return there. In our current situation, we're earning a lot through risk premium and not enough through yield. So all of my recommendations try to push toward the preferred situation, which would be less risk premium. Capital appreciation would be another way to think about risk premium if that term is wonky, and to yield. And so that's what this recommendation does. It's really isn't about alpha or nuance or esoteric or niche. This is really just about using common strategies in the market to solve this problem. And covered calls happens to be the one we're talking about today. If you could, one more. I'll hit this slide real quick. So this goes back to sort of, we're looking for that moderate capital appreciation or risk premium and higher amounts of yield. Those things really are present inside that circle. And you can see covered calls, you can see high yield on one side. So when I kind of think through what strategies I'm thinking are best for our needs right now, they sort of do sit in that inside that circle. And the further down you go, the more return you earn through yield, but just the less return you earn generally. And the further to the right you go and up to the right corner, the more return you earn generally, just higher returns, but you almost get none of it through yield. So those two things are kind of not the best solutions. So I'm trying to focus on that circle. If you could advance to slide 9. And so as a matter of risk, you can see that covered calls, again, are somewhere between equities and high yield, as they should be. The returns are somewhere between equity and high yield. And I would just point you to the beta row. You can see that equity has a beta of 1, high yield has a beta of around 0.4, and covered calls are around 0.8. And beta is a wonky term, but I'll tell you how to use it. If you have a beta of 1, you basically take the S&P 500 return and multiply it by 1, and that gives you your return. So if you own the S&P 500, you get the S&P 500 return, right, times 1. If you own covered calls, you would take the S&P 500, you'd multiply by 0.8, and that would kind of give you the range of what you expected in the covered call return. And the same thing with high yield at a 0.4. That's how you use beta. I know we like to talk smart, but it's really not as hard as it seems. So if you could advance one more slide. So the takeaways, really, I won't spend too much time on it. We're trying to generate yield, and in order to generate current yield, we have to give up some future upside. Would be no different if we moved from equities to bonds. We would be doing the same thing. And the other piece is this low beta. We've got a lot of equity in the portfolio, the 1.0 type beta equity. And so having something that sort of takes some of that beta away is not a bad thing. It diversifies the portfolio, and it helps manage the equity risk. We could have used things like long-short hedge funds or tail risk hedges or other just risk hedging strategies. But I think that because we need the yield today, covered calls is actually the best fit for us right now. This recommendation isn't necessarily predicated on that piece. It's just a positive attribute. So if you could advance one. So the recommendation to slide 12. The recommendation for today is that we put a 3% policy allocation for covered calls using the S&P Buy Right 30 Delta Index. It's published by S&P. It's liquid. It's transparent. And it's small enough to make an impact on yield, but it's not big enough that we're really putting ourselves out there very much. And that will be part of the motion when I turn it back over, or when we turn it back over to Glenn. So if we go 2 more slides. The next recommendation we'll talk about is microcap. I see this across the country. You kind of go, we own large cap, mid cap, small cap. We hop right over microcap into private equity. And I've never really understood why, and I'll show you my logic for that and reason. The real risk is that microcaps have lower performance than private equity. That's the real risk, and I'll show you through the performance in a few slides. But what the benefit is that microcap managers charge around 1%, whereas your average private equity fee dollar is between 4 and 6%. So if you move 2% from PE into microcaps, you save 6 basis points annually, which seems kind of small maybe, but that's 5% of our total fee level. So just this small move, the 2% move can save 5% in fees. That seems to be the kind of thing we should at least talk about a little bit. Another plus about microcaps, even though it's only in the margin, is that microcaps do have a dividend yield. So again, we're trying to yield, and we're trying to get as much of that cash flow as we can kind of passively. And microcaps do aid that some, although not much, and you'll see that in a few slides, or the next slide, actually. So if you just think through microcaps, you can see this page sort of goes through what the average microcap market cap is for these stocks. Some are bigger, some are smaller. If you focus on the microcap row and the private equity row, you can see that the market caps are similar. They're small, right? That microcap is why that's named that way. The number of constituents they're reasonably comparable. I think we have like 800 names at least in the private equity portfolio. So private equity is still a diversified investment when you build it out. The leverage is a little bit higher in private equity. And again, microcap has a dividend yield. We wouldn't expect a passive dividend yield from private equity, even though they do return capital, but we don't control when that happens. So that's kind of, you can see that they're similar in their makeup. If you can flip one more slide. And then I'll kind of show you through returns. So if you look over at again, focus on the microcap and private equity sections, you can see the returns are very similar. And these returns for microcap are based on the index. If you look at microcap, and I think there's a slide in Tom's presentation that can go through this, microcap, the index is not a very efficient index. So the active management community has found a way to, I would just call it, they avoid the bad stuff and they tend to focus on the good stuff. So they've found ways to outperform microcaps, the index. So if we use active management, at that point, you can see the returns are going to be very similar to private equity. And so again, if your returns are similar, you're saving money and you're earning a little bit of yield, but we're not betting the farm on this position either. It seems like a reasonable thing to at least bring up. So if you could advance one more slide. The recommendation for microcaps is a 2% policy allocation with a range of 0 to 4, with a corresponding reduction in private equity from 14 to 12. If you go 2 slides, the last recommendation for the equity portfolio has, and we're on slide 19 for those following along in board docs. For me, it's more about just thinking about equity in totality. We talk about public equity and we talk about private equity, and the only difference is public and private. They're both equity. So we should really be thinking about, when you're thinking about it in a larger risk context, you're thinking about equity. So if you look at this table and you kind of look at the old targets, you can see that, there is no total at total equity. We manage within these individual rows, when in reality we should be managing our equity exposure at the highest level. And so you can see in the new targets or the recommendations, there's a total at equity with a range around it so that we can rebalance and stay within these risk tolerances that are important. That's how we can control the risk and the asset allocation. It's important for you folks. So this allocation in general was me kind of putting myself into your shoes and saying, what would I want if I were you? And I would want that. You can also see the addition of microcap and covered call or buy right in there at the recommendations that I gave you on previous slides. There's no change to international or emerging markets. The microcap came from private equity, so you can see a corresponding reduction from 14 to 12. And the buy right came from large cap stocks, so you see a corresponding reduction from 21 to 18. And remember, we're going from large cap stocks to large cap stocks. So that's why that risk transfer happened that way. A bigger thing as well is that I offered a range around private equity. It's something I would want if I was in your shoes. It'll create more commitment discipline on staff side and consultant side. And it just makes sure that we're kind of, observing how that portfolio is working and growing relative to the public market. So I thought that was a good way of kind of making sure that you folks could know that private equity can't grow to the moon. And it's going to create a little bit more discipline for us, which I think is a good thing to do. And it also recognizes, we go to the next slide. It also shows that really our private equity funding, by and large, because it's equity, should come from public equity, right? So those percents in those rows need to all be moving together. So when we get a private equity call, we should be taking it from public equity to the extent possible, because that's the best risk transfer. If you think about asset liability management, we obviously think about it at the fund level, total fund level relative to the pension liability, but you can also think about it at the funding level in private equity. the best place to get your funding for private equity would be from a public equity, because if the public equity market falls or rises, you're selling a equity that went up or down to buy an equity that went up or down. So that's the best risk transfer, so it makes the most sense. And that's what that table attempts to codify, if you will. And one more slide. So the policy change or the recommendation here is that we kind of combine the equity allocation together, publics and privates, and that when you look at the exact weights, it says the ranges are to be determined, but in fact, I think that slide 19 is the recommendation. So that slide on slide 19 is exactly what I would be recommending become the new policy. And if we can flip to 23, we can kind of see, we go back to, remember, the negative cash flow elements. So if you look at the portfolio beforehand, that's the old target yield percentage and weighted yield, kind of the three columns on the left there. You can see that our yield in the kind of the current structure is around $250 million a year. And through these changes, if you go all the way to the right column, you can see that we add about $100 million a year in yield. And so again, that was the focus of all of these recommendations. And in fact, small changes can have a reasonable impact. Again, I think it's marginal. And if you go back to, if you thought about slide number 2, we've got about a $50 million monthly need for cash, and this pays for about 2 extra months. So not bad for a few small changes, I guess is what I would say. That is all I have, and then I would turn it over to Tom Shingler unless anyone has questions of me. Doesn't look like there's questions, so Tom, floor is yours.
I have a question.
Oh, sorry, I apologize.
I'm sorry, I don't know the raise the hand function on Teams. I apologize. So Seth, what's the worst case scenario and greatest risk for us employing a covered call strategy? I look at that as a highly risky proposition, and you didn't really cover that. Can you give your thoughts on that?
Yeah, the biggest risk is kind of go back to kind of call it 95 to 99, where the market's just ripped and they had no quit in them, and you're just constantly selling upside, right? And that's the risk. That's the big risk. Actually, if the markets decline or they don't go up by much, covered calls really aren't that big a risk. So the return you receive from covered calls should be similar to what you would receive from the market. If the market goes down, you'll be better off because you'll be selling that upside that won't materialize, but you still get paid for it. So the real risk is just a runaway market to the upside. And then you would have wished that you hadn't sold that upside in exchange for current yield today. That's the risk. The calls themselves, if you just think about options generally, these are very big markets. They're very mature. They're very organized. They have exchanges. So we're not dealing with esoteric derivatives in any way. These are very common derivatives. Jim Bloom has spent much of his career in that world, so I would probably just defer to him to let you talk about how that stuff is organized. So I wouldn't call that the biggest risk at all, Senator. I think the biggest risk is, just some tearaway market, which we can all guess at, but I don't know that I see that today. Maybe we're getting in toward the end of one, because it's been tearaway since 2012, and since about April of 2020, it's been on a rip. So that is the biggest risk, and I would also defer to Tom to put his 2 cents in there. I think that might be a fair way as well to get a different perspective on what the risk is.
Well, I guess you could make an argument, for either way, which way the market's going, sitting here today with what's going on there. How on a daily, weekly, monthly basis, how many covered calls are you planning on managing?
We are going to hire managers to do this. So, you have to have an operational back office and infrastructure in order to do this. So you hire people who have experience doing it. There are multiple strategies you can employ. Some of them just sell covered calls on the index. Some of them go in and sell covered calls on each of the individual names. Generally, selling the calls on the individual names is a little more profitable because even when you have, let's say it's the S&P 500, in a 500 name index, some of them go up and some of them go down. Well, if you're selling covered calls on 500 names and half of them go up and half of them go down, the ones that go down you keep the premium on, and the ones that go up above your strike price, that's where you're giving away your upside, so to speak. But that's not all of them. So that's generally how the market's structured. But it would definitely require the help of a manager. We couldn't do this internally.
Well, that led into my next question. Were we going to do it internally? And if we thought our staff was capable, just going back to the prior presentation, I think we spent like $200,000 on our consultant to do a very simplistic rebalancing, which I would have thought we could have done internally. So, I mean, what number do you figure this is going to cost us in a consultant to manage this? And has that been figured into any of your presentation here?
So yes, and I think Tom Shingler has a little bit more on it. Now I think so. I want to take 2 points here. The rebalances we do internally, we pass them by Tom as somebody who can represent you in an independent fashion, so that there's a check there that we're not off the reservation and doing silly stuff. And I think that's sort of best practices in the industry. So when I think through what Tom is doing, he's kind of serving the purpose of the board in the sense that he's not going to let anything silly happen during an ordinary rebalancing, and in fact he does a good job of that. So in terms of what you pay the consultant to do, I don't necessarily think it's just rebalancing. I think rebalancing the way we're doing it now, frankly, is free to us. You're paying staff already. We're coming up with the recommendation, and we're getting with the managers to both buy and sell the way Jim explained it earlier. As it relates to the managers we would hire, you're talking around anywhere between a 15 and 30 basis point management fee. That's sort of what I'm looking at. I think you can get charged more, but those are for more kind of high octane, go get 'em strategies, and that's not what we're doing this for. I take you back to slide number 2. What we're doing this for is yield, and that's not incredibly difficult in terms of the the brain cells that are burned on doing it. Really, what you're paying for in that management fee is there's from a back office context, so from an operational context, you got to exchange some collateral and stuff like that, and so you have to have people who have that infrastructure set up to do that efficiently, and they charge for it. But also if you think about 15 or 30 basis points in management fees, that's not incredibly high. Your average, I would say, a kind of a run-of-the-mill active equity manager is going to be 30 to 60 basis points. So this is even cheaper than that. But there again, it's not as cheap as like the equity index broadly, right? You can run S&P 500 for a bip or two, a basis point or two. So it is a little bit of an escalation in fee, but it's not high fee in the context of the fee spectrum that I live in. Does that answer your question?
Yep, thank you.
Mr. Bloom?
Chairman Becker, I'm not in the seat right now, but since Seth had mentioned me, would it be okay for me to say something?
Oh, no, please, absolutely. We look forward to it. We know you have a good background in this, so please.
I just wanted to reiterate what Seth said is the the only real risk you have in a covered right position, a covered right strategy, is a runaway market. However, if we did have a runaway market, we still have 24% in domestic equities that are not we're not writing calls on. So we'll do fine in a runaway market. And I think the idea of increasing yield and having a little bit of downside protection from covered calls is it's a positive and an excellent strategy. And I'm delighted that Seth, and I think everyone at Banking and Securities is delighted that Seth brought that to us. Thank you very much, Chairman Becker.
Great. Jim, thank you for those comments. That's very much appreciated.
Okay. Chairman Becker, should I cover our presentation?
Please, yes.
Okay. Thanks, everyone. Hope everyone's doing well. In terms of directing slides, who's actually doing that so I can refer to them by name and try to be helpful? Is it Susie?
I am, sir. My name's Katie.
That's Katie. Okay. Thank you, Katie. So for Callan, we have our presentation that's on board docs. My colleague Kevin Matchis and I are going to go through a few key slides here. So what we did was we looked at the equity index versions of what SIRS has today in U.S. equity and then the proposed structure from SIRS.io. So comparing the two, what are the differences between them? What are reasons to move to the new structure? What would be reasons to stay where you are? And we went through this analysis with our team, Bud, Britt, and myself, with Kevin from our Capital Markets Research Group, and then we went to our Client Policy Review Committee that's chaired by our president, Jim Callahan. So that's the product that you have in front of you. If we go to slide 5, Kevin's going to start covering this slide, and we're going to cover a few key slides. So it says Introduction to Proposal on that slide if you have it up in front of you. Kevin, do you want to start right here?
Sure, yeah, thank you, everybody. So here on the left side of this slide, you can see the current investment policy statement states that the Russell 3000 index is your broad domestic equity index. The current structure, as laid out in the IPS, also states that there will be this 20% weight to small cap, and here we represent that with the Russell 2000. And so the proposed structure, there you can see we have incorporated the new Russell microcap allocation, as well as the covered call strategy shown in orange there, represented by this BXMD index that you've just heard about. And so there's really two separate decisions here, right? One is that allocation from private equity to microcap, and the other is the covered call allocation. And so we look at on the table on the right, what are sort of the implications of those two decisions when taken together. So when we look at total dividend income, when you include the impact of reducing private equity, that results in a higher dividend income under the proposed structure. When you look at option premium, in the current structure, there is no option premium, but that will be present in the proposed structure. In terms of potential return, we think that under the proposed structure, because of the incorporation of covered calls, that does have a relatively lower potential return, and that's tied to the next line there is volatility. It does have lower risk, right? So we think that there isn't necessarily that free lunch, that higher return comes with higher risk. But we think it's important to point out when it comes to tracking error to the Russell 3000 that this is going to be increasing under the proposal, right? So tracking error just means the extent to which the difference in return from the Russell 3000 index is volatile or not. And so because the new allocation looks so different from the Russell 3000, the Russell 3000 becomes sort of a worse benchmark index. And so we'll get into the implications for our recommendation because of that. We've already talked about total fees. When you include the impact of private equity, total fees are coming down. But we'll also get into the details of looking at the public equity fees. Those if viewed in isolation, are increasing. And finally, we highlight that there is some additional complexity that comes with a covered call strategy compared to just being long-only equities. We'll also just mention briefly in passing that in the appendix, you'll see more information on covered calls on pages 22 and 23. We don't have to turn to those, but there from our covered call education, you might remember that there were some materials on the merits and considerations or risks associated with covered calls, since I know that is a topic of interest. But turning to page 6, we also wanted to highlight this concept of the premium, right? You've seen the gross premium talked about before, right? That is the cash flow that's received at the initiation of the trade when you agree to sell that call option. And so what we're doing here is looking at an annual net option premium. And so when we say net here, this doesn't refer to fees. Everything we're looking at is going to be gross of fees, so we'll be comparing fees separately from returns and looking at both. But here, what net refers to is that we're accounting for the losses on options trades, right? So if you wrote a call and the market went up, for example, the stock market trended higher, that would be causing a loss on your call. And so we're also incorporating the risk so that this annual net option premium represents kind of an economic impact rather than a cash flow impact that you see with those gross option premiums. So we look at that annually, and we actually do a 5-year average in this case for each of these data points to sort of smooth out, because there is a lot of noise as the stock market either goes up or down month to month. And so what we find is that over this long-term time period, this BXMD or the buy right index that is being proposed, that averaged 1.56% per year in annual net option premium. So turning to slide 8, I want to make sure we cover this slide. This does detail the proposal in dollar allocations as well as the fees, so you can see those fees in percentage terms as well as the fees in dollar terms. So I know that was something that just came up. You'll see for the microcap allocation, there's a relatively larger number of managers whereas the covered call allocation has a relatively smaller number of managers too. And so in the case of microcap, those smaller mandates are kind of necessary because of the niche market that these managers are playing in. And the smaller number of managers with covered calls, that represents the ability to concentrate assets with fewer managers in order to save on fees. And so these numbers of managers we put out there, we describe them as preliminary. These are not prescriptive, but really were meant to help us estimate fees. So you can see that the total fee in percentage terms, when looking at public equity in isolation, not including private equity, does rise from 5 basis points to 13 basis points, or about $4.5 million to about $11.6 million. So just wanted to be clear about what these fees were that would be involved in each of these allocations.
Just to add there quickly that relative to the senator's question and what Seth was talking about, so what we took for microcap and covered calls as the proposed fees, those are based on our outreach to managers, recent manager search activity where we actually were doing live searches in microcap. So we can't say that precisely this would be the case, 85 basis microcap manager or 20 basis points for covered calls, but we believe these are reasonable estimates of what those mandates would cost at those asset levels.
Okay. So turning to slide 12, we wanted to highlight this metric for excess return on a 5-year basis because this is what is highlighted in the investment policy statement. So you can see there the current structure using indices to calculate returns in dark blue represents that current structure. And we compare it in the teal color to the proposed index structure. And so, this is kind of what I was getting at before, is that you can see already that there's more deviation from the Russell 3000 index in teal. Could be positive, could be negative, but greater in magnitude. So turning to slide 13, here we're going to show a similar piece of information, but we're looking at returns now instead of rolling 5 years. We're looking at it on a cumulative basis, right? So we're looking at those returns relative to the Russell 3000, and it's the drawdown relative to that index. So it's only looking at the downside, not the upside. And so, what we can see here, in particular on the right side of the chart, is that there has been this period, where under the current index structure in dark blue, that overweight to small caps that's present in the investment policy statement guidelines, that did result in some underperformance relative to the Russell 3000. And so, that has been, fairly prolonged over, since 2011, really. And, when you look at, similarly, that time period since 2011 in teal, that was a larger drag on relative performance. Again, all relative, this is a period where the equity markets have trended higher. And so, I would say no surprise to see that the lower volatility approach incorporating covered calls is not able to keep up in that kind of running market. And so there is that cumulative effect that could be something that you really want to have the risk tolerance to be able to withstand, right? It's not a negative total return, but it is a negative relative return compared to the broad market. Turning to page 14, this is similar to something we viewed in the covered call education presentation previously, the same time periods of declining equity market environments. And so what this shows now is, instead of just looking at the covered call index, but looking at our proposed structures. So the current index structure is in blue, the proposed, again, is in teal, and compared to the Russell 3000 index. And so what we see is, at the margin, that incorporation to the small allocation of covered calls does add some protection here. Just, we think at the margins in these protracted bear markets. So not universal, depends on whether it's a short-term bear market or a long-term bear market, but in general, our expectation is that in these more protracted bear markets, that covered calls could provide some downside protection in terms of these returns. Now, turning to slide 15, this gets to the question about what are the greatest risks that come with incorporating covered calls in this proposed structure. Again, now looking at periods where the equity market is rising, I would highlight, for example, the third from the right period from October 1, 2011 through September 30, 2018, right? It's a 7-year period of a really long bull market. And so that's where you see, that greatest underperformance historically was in that sort of runaway market, where the proposal was just not able to keep up with the broad markets. So turning to slide 17, to conclude here, our recommendation is that if you're to go forward with these two investment decisions, reallocating from private equity and microcap, as well as introducing this 3% allocation to covered calls, that would require that the benchmark in the investment policy statement would have to change. So the current benchmark is used on rolling 5-year time periods, and it's the Russell 3000 index. And so that index would have to change to the blend shown in the table on the bottom left, using those target weights. And so that would be the performance you look at for performance reporting and attribution. And so you'd no longer be concerned about whether you're outperforming or underperforming the broad market, but instead how your active managers, for example, are outperforming or underperforming this benchmark. And So, when we think about on the right side of this page, this investment decision, again, highlighting that this reallocation of 2% from private equity to microcap equity, that we think increases liquidity and transparency, as well as saving on fees without sacrificing much potential return that can come from being in private markets that are less liquid. But when we turn to the kind of second investment decision, the introduction of covered calls, what we see is that kind of allows for option premium. It does lower total risk, but we think that it does kind of sacrifice commensurate potential return. And so with that, I'll see if Tom has any other concluding comments before we go to questions.
Thanks, Kevin. I would add that, so on the policy, you might be wondering, okay, why would we want to change this? Because you could keep the Russell 3000, say, as a secondary benchmark, but as a primary benchmark, they're too different to keep it. For example, if you look at that on 17, there's that little box that says U.S. large mid-cap. It would be 18%, 27% of U.S. equity. That actually makes up today about 94% of the market. So in this proposed structure, it would be about 2/3 as opposed to 94%. So you've got this huge difference in the, and that would create a lot of tracking error. If we're looking on this on a month-to-month basis, on a quarter-to-quarter basis, it's not a meaningful way of measuring performance because the allocations are too different. You could say it still has value. We want to look at what's the opportunity cost, as we've been talking about in this presentation. If you move to this new allocation, what's the potential opportunity cost, like Kevin just talked about, in a protracted bull market that you wouldn't keep up? So you might want it as a secondary benchmark. It keeps it there to measure that aspect, but it's not going to be meaningful to measure how the implementation is working month to month, quarter to quarter. And the other point that's key here that we have on the top of 17 is that we've gone through multiple rounds of these presentations, and it's important to keep in mind that these are separate decisions. So one is about microcap versus private equity, and the second is about introducing covered calls. You could do neither, you could do one, or you could do both, but they're related. They have their own merits and considerations, each on their own, and they shouldn't be conflated as decisions. They should be viewed separately. So I'll stop there and see if there are comments on what we've talked about here.
Tom, if I can add one thing, I think the words lower return were spoken many times, and I just want to, the bad part about this is we take this in component parts. So we're talking about the equity portfolio, but, to jog the memories of the folks that were here in December, and then for the benefit of Representative Schimmel and Treasurer Garrity who weren't, when we restructured the fixed income portfolio, we actually increased the return we expected to come from the fixed income portfolio to generate more yield to pay benefits with. While in this structure, the covered call piece would tend to be a lower returning investment in the equity portfolio in order to generate more yield. So when you add those things together, when you're looking at the whole pie, the return is not materially impacted. And so I think it's important to remember that through the fixed income structure, we increased return and we increased yield. This one, we decreased total return, but we increased yield. The pie still sums to the same thing. We're just generating more yield. And so the bad part about doing equity in one swing and then fixed income is another is that we've had several months of gap. And so those two decisions aren't necessarily distinct. They are put together, at least in my head, as terms of how I think through the best way to solve this problem. And so, while you should expect lower return, as we've talked about in the equity portfolio, you should also expect more return out of your fixed income portfolio, which is what we talked about. So I guess what I would caution is getting overly concerned about the terms lower return in the equity portfolio, because on the flip side, you have the offsetting higher return in the fixed income portfolio, all of which increase yield And as we've discussed, there's a preference for yield because we're negative cash flow. And so that's how those two things join, at least in my mind, and why I brought them. To me, they come together as a package, even if we're discussing them as separate decisions.
Okay, no, thanks. I think that's good to give the context. And specific to the equity, what we're across that Kevin used the phrase, and that's the phrase we would use, is the no free lunch, that covered calls have their benefits like you talked about in terms of the yield, but there is give up, right? So we don't want to, we want to make sure the board understands what are and that they understand that aspect, that it's not, either is imperfect, right? You have to understand what the merits are, what the give ups are, and decide. But the bottom line is there is not a free lunch, and we could get both. We have to give up a little bit on one side for the other.
Are there any questions for Tom or staff? I'm hearing no hands are raised, so I will turn it over to Chairman Becker, who can go through the motion if we're ready for that.
Good, thank you. And thank you, Tom and Kevin and Seth. Thank you. It's very informative, very helpful presentation. And hopefully everyone saw on board docs there was kind of an explanation of this that explained all the changes that were being that we're talking about today. I thought it was very well done. So so a motion is in order. So allow me to read the motion. And a motion is in order to recommend that the State Employees Retirement Board approve the following enhancements to the Defined Benefit Plan's investment policy statement. A, enhanced U.S. equity structure, which is section 20, page 32, and B, updated policy target asset allocation percentages, estimated risk percentages, and liquidity levels found on section 21, page 39, section 23, page 41, and section 24. The revised sections are in the attached meeting material entitled Public Equity Manager Structure Analysis Defined Benefit Plan IPS, updated on a PDF 4/28/2021. So may I have a motion, please?
So moved.
Okay, we have a motion. May I have a second, please?
Second.
Second, please. Thank you. Okay, we have a motion and a second. Any further discussion before we go to roll call? If not, Jim, may we have a roll call vote, please?
Yes, Mr. Becker. I didn't catch who seconded that.
Who was the second on the motion? Did you?
It was Richard A.
Okay, good.
Thanks, Hammer.
Yeah.
Okay. Start with you, Mr. Becker.
Aye.
Senator DeSanto.
This is Chuck Erdman. Senator DeSanto has stepped away. Senator supports the mid-cap strategy, but not the covered call. But since we're doing this together, it'll be a no vote.
Thanks, Chuck. Chairman Philman.
Aye.
Representative Frankel.
Aye.
Treasurer Garrity.
Aye.
Senator Hughes, or Tony Marchowski for Senator Hughes.
Apologies if this isn't the place. I probably should have raised my hand earlier. Is it possible, based on Senator DeSanto, we're in the same boat, is it possible to separate the motion? Or does it have to be done as one?
I would look to our legal team if we want to go in that direction. We'd have to have a new motion, obviously.
My apologies for not raising that earlier.
The motion, this is Joe Marcucci, Chief Counsel. The motion can be done in two parts. We can do the, we'd have to look at the text of it and come back to you with these references. I can't make.
Okay, well, as to not complicate it, we'll be voting no because it is together due to the covered calls.
Okay, great.
Thank you.
Okay.
Thanks, Tony.
Thank you, Tony. Appreciate that.
We'll continue down then. Chairman Becker, should I continue on?
Yes, please.
Okay. Mr. Jordan?
I'm going to vote no as well for the same reasons that Senator Hughes and Senator DeSanto brought up.
Okay, thank you. And Mr. Thal?
Aye.
Secretary Begg?
Aye.
Okay, 2, 3, 4, 5. 6 yeas and 3 noes.
Okay. Great. Okay. Well, okay. Thank you all. So the motion passes by a 6-3 vote. Thank you. Seth, I will turn it back to you.
Thanks, Chairman. So the next section is item D in the new business. We have started a long credit manager search, as we talked about in the fixed income portfolio or fixed income restructuring. The long credit index is suboptimal. I think there ends up being some stuff in there that can be easily avoided, and therefore the active management community does a good job of adding value to that index. And you know, it's frankly, if I tend to view active management as kind of throwing darts at a dartboard. If I have an 8 out of 10 chance of picking a winner, I'll take that chance. If I have a 5 out of 10 chance of taking a winner, I'm not taking that chance. In the long credit space, you're kind of at 8.5%, or 8.5 times out of 10, you're going to pick a winner. You know, and as somebody who doesn't think they're whiz bang at picking managers, I still feel pretty good that if 8.5 of them can beat the index, even a guy like me can add some value. So what we've done is looked for active managers in that space. The issue is we're going to have about 4 managers, and if you kind of think through private equity hirings, that's about 20 minutes a manager. You have, you know, it's an 80-minute meeting just with that before anything else is added. And on top of that, by the time we get done, there'll be about a month delay before we can get the managers approved, and then you have to add on to that the time spent with legal negotiations and other things. So what we would like to ask for is as follows. If you can go down to the next page, please. That kind of describes the timeline there, so you can see where this proposal truly is about efficiency. And it, you know, as you'll see in how it works, it does not take authority away from you. So if you can go down to the next slide, please. So really the way we want this to work is Callan and staff will come to the conclusions on the managers that we think are the best fit for the portfolio. When we do that, we'll go through we'll send you all our work just like we would, you know, with a board meeting or any other decision you would be asked to make. You'll have all the manager work from both staff and Callan to read and review. So we'll send you, Jim or I will send you that email. And we'll give you 2 weeks to review it and of course, call us back and ask questions and make sure you understand what you're being asked to do. And so at the end of that 2-week period, if we've really heard nothing from anybody or nothing negative, if everybody, it seems to be, basically it's a silence is consent kind of approach. So if you're okay with it, you just kind of say, yeah, and you don't say anything. If you don't like it, you tell us, I don't like it, I want this taken to the investment committee, and immediately that hiring process stops, and it will go to the next investment committee meeting to be heard by the full committee, where you can where you can discuss your concerns with your peers. So basically, if there is one member of the investment committee that does not want it to happen, it will not happen. But if everyone's generally okay with the hire, then that'll give staff about a month head start to get into the legal negotiations and stuff, so that we can continue on with this fixed income transition in as efficient a manner as possible. So really, as I thought through this setup, what I was really thinking of is how can we create efficiency without degrading the authority of the investment committee, and this was the way I put thread through the needle, so to speak. So that's kind of the setup we're asking for. I would be happy to take questions at this point. Any questions? If there are, you can just shout them out.
Hey, Seth, I would just emphasize that, as you have emphasized, this is strictly for efficiency, and it's only pertaining to the search for long credit managers. It's just for that particular effort. We're not, when it's not expanded beyond that. It's just as we assemble the team of long credit managers in an efficient manner. That's why we're asking for this authority.
Yes, that is absolutely correct and a very good point. Thank you, Chairman. If there are no questions, I suppose, Chairman Becker, it's your show.
Okay. Thank you. So a motion is in order. Allow me to read the motion. It's a little long, but a motion is in order to recommend that the State Employees Retirement Board delegate authority to the Chief Investment Officer to hire actively managed long credit mandates to increase efficiencies in the implementation of the enhanced fixed income structure through the following process. 1, the Chief Investment Officer and the Board's General Investment Consultant will provide recommendation memos via email to the Investment Committee which detail the rationale to hire the actively managed long credit mandates. And 2, the Investment Committee members will have 2 weeks from the time stamp on the sent email to review the recommendation. And 3, if Investment Committee members are comfortable with the hire and there are no further objections during the 2-week period, SIRS will proceed with hiring the actively managed long credit mandates. And 4, if any Investment Committee member objects, SIRS will postpone the hiring process and provide the recommendation at the next Investment Committee meeting for a formal vote. So may I have a motion, please?
So moved.
Thank you. We have a motion. May I have a second, please?
I'll second.
Second.
Thank you. Any further discussion before we go to a vote? Okay, if not, Jim, may we have a roll call vote, please?
Yes, I heard 2 people second. Who is the official second?
I heard Tony.
Give me
Jim.
Greg Thal. I heard Tony too. So.
Tony, you confirm that?
It was not me.
It was Treasurer
I
Gary.
thought it was the treasurer, wasn't that?
It was.
Thank you. My bad. Okay, we'll start with you, Mr. Becker.
Aye.
Senator DeSanto.
Aye. And
Mr.
this is
Tillman?
Chuck Erdman for Senator DeSanto.
Okay. So that's a yes?
Correct.
Okay, thank you. Chairman Philman.
Aye.
Representative Frankel.
Aye.
Treasurer Garrity, obviously.
Aye.
Yes. Senator Hughes, or Tony, on behalf of Senator Hughes.
Aye.
And Mr. Jordan.
Aye.
Mr. Thal.
Aye.
And Secretary Vague.
Aye.
That makes it easy. Glenn.
Okay.
Vance.
Okay, the motion is carried by unanimous vote. Thank you, everybody. And Seth, we still have one more item we need to cover. I'll turn it back to you.
Yes, sir. Thank you, Chairman. So the last item is item E, and it's the transaction cost consultant. Basically, what this is how we make sure our managers are trading stocks in as cheap a way as possible. Kind of these things sort of came to being when soft dollars were still a bigger force in the industry. Fortunately, some of that's gone away. And so, but it really is a fiduciary best practice to make sure that our managers aren't using SIRS dollars to trade at high cost, which can accrue to them. So we definitely need a transaction cost consultant. Most of these firms have consolidated. There's only a few left. Abel Nozier is definitely the biggest in the business, most well known. And so what we need is the permission to extend the contract that we have in place. And that's really what this is. If there's any questions, I'll take them now.
Okay.
No questions. Chairman Becker?
Sure.
Floor is yours.
Okay, we'll go to a motion then. Allow me to read the motion, and it's a motion is in order to recommend that the State Employees Retirement Board authorize the retention of Abel Nozier as its investment transaction cost analysis consultant under a new consulting agreement subject to successful completion of contract negotiations prior to the expiration of the current agreement between SERS and Abel Nozier. May I have a motion, please?
So moved.
Okay, we have a motion. May I have a second, please?
Second.
Okay, we have a motion and a second. I think, Jim, may we go to a roll call vote, please?
Okay, could I get identification on the second? Once again?
Rep. Frankel.
Thank you. We'll start with you, Mr. Becker.
Aye.
Thank you. Senator DeSanto? Or Mr. Urban?
Chuck Erdman for Senator DeSanto. Aye.
Thanks, Chuck. Chairman Feldman?
Aye.
Representative Frankel?
Aye.
Treasurer Garrity?
Aye.
Thank you. Senator Hughes or Ms. Marchowski on behalf of Senator Hughes?
Aye.
Thanks, Tony. Mr. Jordan?
Aye.
Mr. Thal?
Aye.
And Secretary Bagg?
Aye.
Okay, that's another easy one.
Okay, motion passes. Thank you. Seth, I think there's under these bullet points, I think you have two more, which are just really more for informational only, but if you want to make a comment or two about them, please feel free.
So, yeah, those two reports, the item G that's given to you basically at every meeting, and item F was basically discloses the changes to any contracts that were made for public market managers, and it's an annual report, and it'll be provided, at this meeting every year. But at that, I would just say, are there any questions on those reports? We're not seeing any. So if not, Chairman Becker, I would then just sort of ask, we can move through to the executive session, and if there are no questions on the executive session reports, that is all I have, and then I would turn it back over to you.
Good. Thank you. You will find materials on board docs. But unless there are specific questions on the materials, we're not planning to break for executive session. And if there are no questions, I guess we're coming to a close. Are there any additional committee comments, questions, concerns that we can address? Okay. And if not, the next committee meeting will be on June 8th. And I would like to note that we came in a little before our stated time. So we good job, everyone. May I have a motion to adjourn, please?
So moved.
Thank you. Second.
Thank
you, everybody. And we'll take a break for lunch, and we're back on. I don't have my schedule right in front of me. But,
it's at 1:10.
1:10. We'll be back at 1:10. So good. Thank you. Good meeting. Thank you, everyone.